Welcome back to another episode of Travis, Can I Have This? This is a new season for Travis, Can I Have This podcast. Podcasters do that. They have different seasons. I've been taking a break here from podcasting and ready to get back into it. I'm so excited for this upcoming season and the things that I have planned in this podcast. We're going to have more guests coming on and we'll be talking to more practice owners. I have a lot of clients that have had some great learning experiences that I think would be great to share with the rest of the world. So super excited to get back into this. We're also going to be doing some mini series on different topics. And today we're going to start a mini tax series of tax strategies. So we're going to go deep into some different tax strategies that you may or may not have heard about. Today, you're probably going to have heard about it, but I am so excited to be back and get into this. So let's get going. All right. Many moons ago, I lived in Augusta, Georgia. And if you know anything about golf, Augusta, Georgia is where they have the Masters golf tournament. Now, I lived there for just about 6 months, and it happened to be during the time of the Masters golf tournament. And during the Masters tournament, Augusta, Georgia it's not a tiny town, but it's not a huge town. And there's definitely not a lot of hotels. And there's thousands and thousands of people that come into this town, and was in the first week of April. And when everyone comes to town, when all these golf fans come to town, everyone that lives there rents out their home because there's not enough hotels, and they rent out their home, and that's where basically the golf fans live. And then that week of school in Augusta, there's no school. That's when they do their spring break. So the Masters golf tournament comes to town in Augusta, Georgia, and everybody rents out their house and they all leave and they go to the Caribbean. And everyone would talk about all these great trips they would go, all funded from renting out their house for a week to some drunk golf people. And they come back and get back to living life. So what happened? Now, this has happened for decades in Augusta. And this is before Airbnb. This is before Verbo, like all of that stuff, before it was really a thing, this was happening. And so how people would find, maybe this was the impetus for some of that. I don't know. They were probably using like Craigslist or other like newspaper listings. Like this is how long this has been happening in Augusta, Georgia. Well, years ago, there was a legislator in Augusta, and there was a problem happening. And the problem was everyone was renting out their house. Now, let's say they made $10,000 renting out their house for a week. And they would take that $10,000 and they would spend it all at the Caribbean, right? And going to these big vacations. And it's a really big thing there. And what's happening is, in theory, they just had $10,000 of rental income. So now they needed to file a tax return and show rental income. Well, if they have rental income, then they have rental expenses, and it gets complicated and convoluted. And, is this really important for the IRS? Well, some legislator from Augusta or Georgia with enough people in his ear went to Congress and got a law passed that said if you rent out your personal residence for less than 15 days, so 14 days or less, so you could do it up to 2 weeks, you don't have to pay taxes on any of the income you make. So you don't have to recognize any of the income. You also don't have to worry about any of the expenses. It's just kind of a wash. The IRS doesn't care. Rent out your home for up to 14 days or anywhere. This is federal law, or anywhere in the country, and you don't have to pick it up as rental income. So that's great. So 14 days or less, and you don't have to pick it up. It's in the IRS code section is section 280, capital A, lowercase g. Do you need to know that? Why did I share that? It's a real thing. Look it up. Anyway, so this is great, right? Now, if you're a practice owner and you're listening to this, you're thinking, okay, well, what's the big one? Now, probably the punch where I'm going to go with this, you've probably seen on TikTok or Instagram. This is a popular thing that business owners do. What's the hook for business owners? Well, here's the thing with business owners. If you have a business, specifically a corporation, you are supposed to be having board meetings. You're supposed to be having regular meetings as a corporation. Some states require annual filings and different things to be compliant. And you are supposed to be having board meetings, and you can be going to your local Marriott to have a board meeting. And if the local Marriott costs $1,000 to rent out a boardroom for that day, maybe it's for a 5-hour meeting that you're going to have and discuss strategy of your practice and loans and equipment purchases or whatever it is, right? You could go to the Marriott and do that. And if you had $1,000 expense to the Marriott under IRC Section 162, that would be considered an ordinary and necessary business expense. So you can write it off through the business, right? So we have this premise of, well, you can rent out your home tax-free. And then as a corporation, you're supposed to be having board meetings. So why not have those board meetings at your house? And so instead of going to the Marriott, you go to your house, and your house has a dining table, your house has internet, your house has all the things that the Marriott has to have the board meeting. And so instead, your corporation goes to your personal residence and it rents out your house to have that board meeting. And now your corporation pays yourself to rent out your personal residence. The expense on the business side is a legitimate expense based on Section 162. It is an ordinary and necessary expense to have a board meeting. And then on the personal side, when you receive the rent, according to Section 280A lowercase g, you can exclude that income as long as you have no more than 14 of those meetings a year. So this is nicknamed in the world of tax strategies, the Augusta Rule. So it came about because of Augusta, but this is effectively what business owners are doing. They're renting out their homes for board meetings. And as an example, if you did this, and let's say you used $1,000 rental rate and you had one board meeting each month. So you did 12 meetings a year, and that's a $12,000 expense to the business. So it's a deduction to the business, but you don't have to pick it up personally as income. That expense to the business, if you're a practice owner and you're in a 35% tax bracket and you have some state income tax, let's just say your marginal rate is 45%, that $12,000 expense would save you over $5,000 in taxes. And that's real savings, right? So think 12 meetings, $1,000. I did some documentation. I did some other things, and I just saved $5,000. Was it worth it? Most practice owners, it is. Some of the times, oftentimes, depending on where you live, you can find fair market rates that are more than $1,000. There's clients that get quotes for $2,500 and they have, over $20,000 of these board meeting rental deductions, and they're saving closer to $10,000 on taxes. And it's real and it's a legitimate thing and you can do it. And I have clients that do it, but there are things you need to be concerned about. And there are CPAs out there who preach against this. They don't like when clients do this. So we're going to talk about some of the nuances and what you need to know about actually executing on this. The first thing you need to know, in order to take this deduction, what's happening is you have a business that's paying you personally. Now, what happens if you own 100% of the business and you are 100% yourself, right? So you're basically the same person that owns the business and same person that owns your house, right? Personally, you own your house. You need to make sure from a tax perspective that there are two separate legal entities. And the best distinction for that is your business needs to be an S Corp, a C Corp, or a partnership. And if you can check that box, then I feel pretty confident that you can tell the IRS that when you pay this rental rate, it's two separate legal entities. Now, there are related party rules and things like that, but from what I can tell, I don't think that's an issue in this as long as it's a separate entity. Where you will get into concerns is if you have an LLC. So LLCs are confusing because if you form an LLC, and a lot of people do, and I'm using the term LLC loosely. Sometimes it's a PLLC depending on your state. But if you have an LLC, the IRS considers that a disregarded entity, meaning it's like LLC is like, I don't care that you formed an LLC. That means nothing to me, says the IRS. And so when it comes to filing taxes, you actually choose which entity you want to be taxed as. And the three choices you choose are you're a sole proprietor, you're an S Corp, or you're a partnership. So you can have an LLC that's taxed as a sole proprietor, an LLC taxed as an S corp, or a partnership. And when it comes to this Augusta rule, if you have an LLC that is taxed as a sole proprietor, that means your taxes are part of your personal taxes. So now the IRS sees you, your business, as a personal business. And if your residence is also owned personally, I think there is a lot of risk for you to do this Augusta rule for an LLC that is taxed as a sole proprietor. Think of like a Schedule C, that's a sole proprietor. So I would not do the Augusta rule. And there's some case law to support this as well, not specifically with the Augusta rule. We'll talk about that in a second. But if you're an LLC or just a sole proprietor, either way, you cannot do this. You need to have an LLC that is taxed as an S corp or partnership, or just have a straight corporation, and then you can do that. So you need to make sure and have that infrastructure set up first to even be able to go down this road to take it. And then we'll talk about some other things as well. Now, one counter argument to all of this. We talked about, let's pretend you have an S corp and you own 100% of it and you own your house personally. So you personally own your house and you personally own the business, the S corp. Could the IRS come and say, they have something called a substance over form doctrine. So they don't like when people just, they follow the letter of the law. And with the Augusta rule, you are following the letter of the law, but they don't like it when it breaks the spirit of the law. And so sometimes they come after this and they take certain things to court and they establish a precedent, right? And so there could be an argument when we talk about some of the details on this, is it's like somebody is they're just doing what they normally do and they're trying to justify it through this Augusta rule thing, and the IRS doesn't like it. I think there's ways around this if you have the right documentation and things like that. But it's a good segue into discussing case law. So a lot of times with tax stuff, there's these code sections. So we talked about these code sections and how we can use them to your advantage to do this Augusta rule. Well, this in theory could make sense. And a lot of people do this with, a lot of tax attorneys get creative with the code section. Well, the code section says we can't do this thing, so it must imply we can. And so they kind of exploit the tax code in different areas. And what happens is the IRS takes some of these cases to court. Now, to get to court, the process is usually long. Usually, you have to have a stubborn person involved, and it starts with an audit. So usually there's an audit involved, and the IRS, disallows something or goes against something, and then the person's like, no, I disagree with that. So let's go to the tax courts, right? Because these auditors, if you get audited, you're not gonna necessarily guarantee you get the smartest auditor. No offense to the auditors, but it's probably not a great place to work to be an IRS auditor. So what kind of talent are they attracting, right? So sometimes you don't get the best auditors. Sometimes you get auditors who don't really understand the tax code. And so very smart tax attorneys will say, well, let's challenge this with the tax courts. And usually when you get to the tax courts, you get a judge and people who are a lot more well-versed in tax code and things like that. And so it's nice to have things go to tax court because then we really see how the IRS interprets things. When it comes to the Augusta rule and its application to businesses, there has yet to be a landmark case go into the tax courts to help tell us really how the IRS is going to interpret this. I think it'll happen eventually at some point, but it hasn't happened yet. I mean, it doesn't mean that people haven't been audited. And if, there's probably been a lot of audits and it's probably been allowed in some audits and it's probably been disallowed, but we don't know because that's not public information, right? So all this is to say is we're still using our best judgment based on how the current tax code is written, based on how similar cases or similar subject matters have settled with the IRS. Okay, so let's talk about the risks of doing this Augusta rule and where people go wrong. Okay, so the first risk, and this is probably the biggest, is the rate that you're using. The rate that you're using for these board meeting rentals needs to be a fair market rate. How do we know what a fair market rate is? There's a couple different angles to go. But if you looked up homes to rent on a per day basis that are similar to your home, you could use that. You could also use a literal quote from a Marriott in a area close to you. So if your local Marriott has a board meeting rate, that is $1,000 a day and you actually get a quote, then that would be deemed a fair market rate. Now, could you go to a Ritz-Carlton to have a board meeting if you have a corporation, or do you have to go to the Holiday Inn? As long as it's ordinary and necessary, the IRS will say. So is it ordinary and necessary to go to Ritz-Carlton? You could try to argue that, right? And this is where we're starting to get on this risk spectrum. If you think your house is as nice as a Ritz-Carlton and that's a comparable rate, or maybe that's the only, hotel close to you or something, right? You could try to argue that. And I'm not going to say you can't. Now, does it add a little bit more risk to the risk pile that's coming? Sure, absolutely. But a lot of doctors have nice houses and the Ritz-Carlton's nice, right? And a lot of times the Marriotts and other places may not be that nice. Who knows, right? So you want to try to find something that is comparable as much to your residence. Now, when you get that quote, you want to make sure, for example, a lot of times they'll have surcharges for having a TV or having food or having internet, right? Those are all things that you have at your house. So you want to make sure include all the things that you have at your house when you get these quotes. I will say, and when I started doing this a lot for my clients, this is probably about 7 years ago, we were calling calling the hotels for our clients and getting quotes, and it was kind of a pain in the butt. And the hotels, it's kind of annoying for them, right? And what I found recently is a lot of these hotels have picked up on this, and there's a lot of people calling the hotels. Now, you can do a lot of this online. It's not just hotels. There's like meeting spaces that you can rent and other things. Again, they might not always be comparable to your house. And so sometimes it's not perfect, but you should be able to find some quotes even by just going online and not having to call, but you can call. Usually you can get quotes that way. Now, your goal in theory is to try to find as high of a rate as possible because that's going to help you from a tax standpoint. But really, you want to find a fair market rate. That's what's going to be defensible by the IRS. Like if they charge an extra $1,000 for a pet lion in the meeting room, well, you're probably not going to have that at your house. Hopefully you don't, right? So just keep it realistic and get a fair market rate. But people just using I'm going to do $10,000 for a meeting. You can't defend that, right? That's a huge risk. And people do get loosey-goosey with the rates they use. And there's a spectrum on that where you start getting out of hand. Risk number 2 is there's not any actual business happening. So the idea of this rental is that your corporation needs your house to do something for business. And the use case I've been talking about this whole time is a board meeting rate, right? But if you're having a holiday party, that's a good example. You're having a holiday party and you're going to do it at your house instead of at a local banquet hall, right? That's a very common, reasonable thing that people do. And you can use your house to have that meeting, and it's a legitimate business thing. But a lot of times people use this Augusta Rule I can do 14 of these payments a year, and they're not actually doing any business at their house. Now, for most of my practice owners out there, you take everything home with you, right? Every conversation with your spouse, every spare moment, you're answering calls, you're looking at loan stuff, you're looking at equipment stuff, you're reviewing charts, depending on your setup, right? You can review notes for the day, your schedule tomorrow. There's a lot of work happening at home. I think the big risk is the third thing. So I don't think it's that you're not doing any business. It's that you're not documenting it. So the third risk is no documentation. So how are you documenting this business activity that's happening? And if you don't document it, it's like it didn't happen. Or how are you going to show the IRS that it happened, right? The IRS is going to assume you're wrong until you prove that you're innocent. It's like the opposite of innocent till proven guilty. It's the opposite with the IRS. You're guilty till proven innocent. So you have to prove your innocence. They assume that the rate you're charging wasn't market. They're assuming that you didn't have any actual business activity. So you need to show them that. And you need to have documentation of the notes, of a rental agreement. Things need to be in place so that is real. The fourth risk is if you're a sole proprietor, right? So if you're a sole proprietor and you saw a TikTok video about the Augusta Rule and you're like, I'm going to start doing this, I think that's a very bad idea. Now, will the IRS stop you? Will they immediately catch this? No, probably not. Are there plenty of sole proprietors that are doing this? Yes. I would absolutely not do it for me, like I think there's enough substantiation in the case law from relevant cases that I want to do it. The fifth risk is if you get lazy with your days, right? So you cannot do this rental agreement for more than 14 days a year. Otherwise, all of the income gets picked up as taxable income, which is basically pointless. We're moving money from your S corp pocket into your personal pocket, and we're trying to get a tax deduction for that. If you go more than 15 days, then you're moving it from one pocket to the other. Not that it would penalize you massively. I mean, it complicates things and it would be annoying. So you don't want to exceed the 14 days. And then, the biggest one is, with all of these things, does just doing this increase your audit risk? And my short answer is it depends. Who else hates that answer, right? Especially from accountants, where it was like, it depends. Well, it kind of depends on how you categorize this expense, right? If this is put as rent expense with your other rental expenses, it probably will not get flagged. Now, if you put it as a separate line item and you call it Augusta Rule, like maybe the IRS would be more likely to see that and question it. So I'm not saying this to say like there's no rule on how you should categorize it, but most of our clients that are doing this, the way we're categorizing it, I don't think it adds risk to being audited just by doing this. Now, if you get audited for other things, doesn't mean they won't ask for this and things like that. But those are real risks, right? Like that could happen. So these risks that we talked about, I think are why other CPAs, I hear other CPAs talk about Augusta Rule and they're like, I hate Augusta Rule. It's overhyped. It's dumb. It's too much work. People are having these sham meetings. They're charging crazy rates. Like if you do it right, you should do a lot of work and it's not worth it. And I don't entirely disagree with that. Like I do think there's people out there who pay hundreds of thousands in taxes. There are some very successful business owners and they owe hundreds of thousands of taxes every year. And they're busy and they make a lot of money. And 1 hour of their time is worth a lot of money. And if they have to spend 1 hour, doing these things and doing documentation, and they're only going to save at the end of the year $7,000 on taxes, right? And they had to spend 7 hours on this, right? Let's just pretend that's the case. And their time is so valuable that it's worth more than $1,000 an hour. That could be a very real thing, right? But I think for most practice owners, the ROI on your time to document this and to do this, to save $5,000 to $10,000 on taxes at the end of the year, I think it's worth it, And no tax strategy is without risk, right? Even buying a car and deducting it to the business, that's not without risk. Like we've seen auto deductions disallowed. There are very few things, besides buying supplies and paying for your regular rent, there's like very few things that the IRS won't challenge, meals and travel and all that kind of stuff. But people do it all the time, right? And CPAs are okay with that. But you have to know, like that could be disallowed. And so in the same context, nothing is without risk. But I think if you have the right documentation, you build a good system for this, to save $5,000 to $10,000 for most practice owners is going to be significant. Part of the reason I know that is my annual fees for accounting. Depends on the service you sign up for, but my fees are $5,000 to $10,000 a year. And I get people complaining about my fees all the time. I'm like, man, I feel like we're working our butts off over here. You don't want to pay $5,000 to $10,000, but hey, here's a way to save $5,000 to $10,000. And it's only going to require maybe a couple hours of your time. I think it's well worth it, but you do need to do it right. So let's go through kind of a checklist. There is a checklist at the end that we can send you. If you email us at info@gouluru.com, I'll send that that'll be in the show notes. But you can get a checklist if you want this. Nothing like trade secret on this. But let's go through the checklist right now, recapping what we talked about. But step one, make sure you have the right entity set up. So if you're a sole proprietor, I wouldn't do it. If you're a C Corp, S Corp, or partnership, check that box and let's move on to the next step. Step two, you want to find the fair market rate. So make sure that you're getting prices on how much a board meeting costs. Make sure that you include food in that. Get a quote on what a fair market rate is. The recommendation, to really do this right, you should find a few quotes, not just one. I mean, if you had one, that helps for sure. But if you find a few quotes, that could help even more. And then step three is you want to have a written rental agreement. I think this is super important, and you want to have something in writing that it doesn't have to be like super formal. AI can come up with these really easily, and just want to have something in writing that you were agreeing to rent this at this rate. And yeah. The fourth thing is you want to track your days. So make sure that you have a calendar of the days that you want to do these board meetings. Oh, and this actually brings up another thing. A lot of times we'll meet with clients, like we have a lot of new clients coming into our firm, and we're meeting for the first time in October. And we talk about this Augusta Rule thing. We want to have 14 meetings a year. And then after talking about what consists of a board meeting and we're going to find fair market rate, it's like, well, they're like, hey, well, I basically had these, right, this year. Even the meeting that I'm having with them right then, they're at their house and they're talking to their accountant and their spouse is there and we're doing all these things, talking about the business. Like, could that be a board meeting, right? That meeting at that time. And oftentimes it can. But can we go back and kind of retroactively pay for these meetings or make a late rent payment or reclassify a distribution and make part of it a rent payment, right? You certainly can, but it does come with some risk. So some CPAs will say absolutely not, it's too risky. Like don't disagree, like it is risky, but you can do it. You just have to understand the risk associated with it. Ideally, you want to set up a system going forward and making sure that looking forward, you know what days you're going to do or roughly how many a month, and when you're going to do it, and then document those kinds of things. So track your days, keep a calendar. Step 5, hold real meetings. So do some real business, whether it's a meeting with the staff, whether it's just a meeting with you and your accountant or an attorney. The visitor can be virtual. It can also technically be by yourself, and you can be doing some work and emailing and different things like that. But you do want to have Step 5, hold the real meetings, have some notes, have some action items, have something to document what was actually accomplished on that meeting. Step 6 is have a paper trail for the money. So ideally, it would be great if you sent an invoice to your business and your business paid the invoice. It could be as simple as making a transfer from the business account to your personal account, which you probably already do for distributions periodically, but you want to have some kind of paper trail that there is an invoice creation. And then the step 7 is make sure that you coordinate with your accountant on how this is categorized. So when it comes out of the business, you want to make sure it's not put as a distribution and that's put towards a meeting or rent type payment. And then on the personal side, you want to make sure it's not picked up as income. So make sure you coordinate this with your accountant so that the categorization happens correctly. Otherwise, it defeats the whole purpose of all of this. So I really like the Augusta Rule. Most practice owners get right into the highest tax brackets. It's all ordinary income. They just get creamed. Every dollar counts. It feels like there's so much of our practice owners' income going to the IRS. It's nice to be able to get back this $5,000 to $10,000 by taking these things that you're already doing, but documenting it, making sure you're following the right processes and things like that. And I think it can be a good thing. But if you get sloppy and lazy or aggressive, don't be surprised if your CPA pushes back a little bit and gets a little bit concerned. Because at the end of the day, talk to your CPA about this. But at the end of the day, if I'm telling a client to do this and then they get audited and gets disallowed, obviously that looks bad on me. But if we know ahead of time, like, hey, we had to have all these things, and if we have all these things and it still gets disallowed, then it'd be a great opportunity to take this to the tax courts and get something in writing to prove, like, hey, we had all our documentation on this. I would say the most common audits that go poorly are the people with poor documentation. When somebody gets audited and the auditor's like, hey, send me all this stuff, and the person just turns over all this great documentation that clearly was not just made up at that time, right? And shows paper trails and documentation and all this stuff, the auditors move on quickly, right? Like they're trying to find people that are unprepared without documentation, again, to utilize the whole you're guilty till proven innocent, right? If you have the documentation on this, I think your risk, even if you did get audited, goes down a lot. And again, it would be fun. I would do it. If somebody has the documentation on this, they get audited, it gets disallowed. I would love to take this to the tax courts. You would be famous. It would be whatever your name is versus commissioner of the IRS. And you would be in tax legends for years for this Augusta Rule thing. Why am I? This sounds sick. What I'm proposing here. Just joking. No one wants to go through tax courts. But honestly, there's so many people doing this. It's going to happen eventually. But get your documentation in line, and you'll be fine. I think personally. Okay. Shoot any questions to info@goaluru.com. We'll have the checklist there. And thanks so much for tuning in to episode 1 of season 2. Thanks so much, and stay tuned for some more exciting episodes coming your way. Thanks. We'll see you.